been in the car business, warranty business, captive reinsurance business for about 27 years. So what am I here to talk to you today about? Choosing the right insurance F&I product provider. Dealers probably get pounded on 20, 30 different companies coming in to offer various F&I products and be their F&I product carrier. So what I'm going to try to do today is simplify what that provider is providing you. More importantly, what are you paying for those services? What should you be expecting from your F&I provider? So when I do this, I say there's two sides of the coin to everything. One side of the coin is service. And when I talk about service, I'm going to get in specifically maybe that F&I rep, that consultant walking into your dealership. What kind of services do they bring? I'm also going to go into back-end participation or underwriting profit. I'm also going to go into what are you spending for those services. I always say you should know what you're spending and know what you're getting for that. So let's first talk about services. I'm going to break it down in three areas. I'm going to break it down. One, program administration, who's handling that program. More specifically, that finance consultant, that F&I consultant walking into your dealerships. What is he providing? Insurance administration. You have a captive management insurance company. What are they providing? Claims administration. Why don't we start with your F&I manager? For that consultant, we're doing that training walking into your dealership. What are some things you should be looking for? Well, first, I would say take a look at that representative's F&I experience. If you can't do the job, how do you teach the job? So you should ask that representative how much F&I experience do they have? How much time they spend setting the F&I desk? Training the manager on product presentation. How equipped are they in training that finance manager doing product presentation? And product presentation in step sales is more important today than it ever has been. Can he or she sit your F&I desk? There's times your F&I manager's spot's going to be open. Either they quit, walked out, you fired them, they're on vacation. It can be a turnover position. Does your F&I representative, when that position's open, do they sit that F&I desk until that position's filled? I don't think there's any better way for a finance consultant, F&I consultant, to learn about a dealership, to get to know the salespeople, the sales managers, gain the respect of your F&I manager than actually sitting that F&I desk. And F&I managers can be somewhat reluctant to take directions from an outside consultant. So, ask them if they sit the F&I desk. They should be able to. They should be able to do that job. That consultant should be some of the best of F&I managers. Do they have an F&I training course? Maybe it's an advanced F&I manager course. I've taught advanced F&I courses. I've taught fresh talent F&I courses. Fresh talent course might be someone with no F&I experience, and they need to be taught and trained from A to Z. So does that company have that kind of F&I training for you? What's the communication that F&I consultant representative have with the dealer? He should be communicating with that dealer on a regular basis. What is your current performances or past performances? What is your penetration for warranties examples? Maybe it's 30%. What are you doing to get that to 60%? They should have forecasts and goals and communicating with that dealer what kind of performances, what is he doing to increase those performances? I think it's always good for them to do a business development analysis on a regular basis. They should have the knowledge to be looking at an F&I department and be able to pinpoint what areas that dealer's hitting on 8 cylinders, or maybe they're not hitting on 8 cylinders. I'll give you an example. When you're running an analysis, I'll take lenders for example. Secondary lenders over the last few years has taken a lot of money from the F&I departments, taken a lot of money out of the dealer's pockets. All right, they're a little looser now, but when you're analyzing lenders, for example, if a finance manager is saying, hey, I couldn't get warranties on these 20 deals because the lender wouldn't finance it, maybe they're not using the right lenders. So they ought to analyze those lenders. Lenders today, you really want to be able to finance at least your warranties and your gaps. That's a lot of F&I money being taken out of that dealership. And if it is line 5, does that provider give you a product to overcome that? Can they still get a warranty on a monthly payment plan? All right. They should, again, be looking at past performance and goals. They should have those goals for that F&I manager. They're 30%, how are you getting them to 60%? What are you doing to get to 60%? All right, a lot of that's going to be product presentation, which I'm going to get into in a second also. Support from the sales desk and salespeople. Let's talk about that for a second. That training should go to salespeople as well as sales managers. I'll give you one example. Most selling systems today are designed to convert customers to closing on per payments. The 4-square deal, OK deal, 2-square, whatever you want to call it, it's designed to go down on a monthly payment. It's great negotiating deals on monthly payments, but monthly payments can be a double-edged sword. It can cost you money just as quick as it can make you money. All right? And I'll give you an example. If you look what goes into a payment, you got the car, you got the profit, you got the trade, payoff, ACV, whatever goes in and makes that payment. But there's only 2 things that make up a payment that you can lower a customer's payment by not touching your gross. Only 2 things. That's going to be cash, and that's going to be term. So if you're going to train on payment negotiation, you need to concentrate on cash and term. I always taught a 3-payment close. Never say no to a customer. Always give the customer a choice. But it's designed to work for cash, extend the term, lower the payment. 3 choice, extend the cash, get cash down, extend the term. If your salespeople are not trained to do that, or if your sales desk is not trained to properly negotiate on payments, guess what? It's costing you money. I also don't think a sales desk needs to quote a payment down to $347.42 for 72 months at 3.47%. I don't think a desk needs to quote payments that exact. Now don't get me wrong, I'm not telling you to load up a payment like in the old days. In the old days, you used to load a payment with all the F&I products and assume it. You can't do that anymore. Those are the old days, that's not compliant. But it's okay for a sales desk to say you're in the 350 range. Go see my finance manager, he works with 12 different banks, and he'll get to a little more exact payment depending on which lender. Give them a little wiggle room, all right? Proper product presentation, no shortcuts. What do I mean by that? Today, you'd be surprised how many finance managers don't do a proper product presentation. All right, I'm going to use warranties for example. You'd be surprised how many finance managers don't bring out a warranty brochure when they're trying to sell it. Now, how do you sell something if you don't build value in the product first? So many times you just throw it down on a menu and say, hey, you got a 3-year warranty and tell you nothing about it. That is not product presentation. You want to get the product sold. I'll give you an example. Electronic, for example, you go through, your finance manager should be pulling out that F&I brochure, that warranty brochure. They should be going through that brochure what it covers. Electrical, for example, covers power locks, power windows, power seats, power antennas. You got 6 to 7 modules in the car. They're $400 to $800 a module. You got 2 computer systems. Those are $1,500 to $2,000 in computer systems. You got an analog braking system, a whole separate computer system there. That's one example in electronics through a warranty brochure. Watch how many F&I managers don't even do a brochure presentation. What they've gotten away from, and I'm an advocate of it, most people do menu selling. I'm all for menu selling, don't get me wrong. I like menu selling, but there's a right way to use it, there's a wrong way to use it, all right? Menu selling came about because there's so many F&I products today. Back when I got in the business, there were extended warranties, credit insurance, and then Gap came along. Now you have paintless dent repair, tire and wheel, keyless remote, your fabric, rust and paint. There's all kind of products you'll see in the F&I department. So menus came out so they could start bundling some of these products. There's so many products to sell in the F&I department, and you're not going to sit there and go through 12 different product presentations. All right, but the key what I want to make on a menu is build the value on 1 or 2 products. And I'll say the main product is our extended warranties. It's still the most profitable product for a finance department. It's the highest customer satisfaction for a dealer. It's the most profitable product for a captive reinsurance company or back end for a dealer. So I teach finance managers, before you bring out a menu, before you go to those payments, go over the warranty, go over what the factory warranty is. If it's a used car, if it comes with a 3.3, what comes on the car? Then go over the options for the extended warranty. Do the full brochure presentation. Then tell them that warranty, how much it is per month. You're going to get the objections or they're going to buy. But stay on that warranty before you buy it, and then maybe get. So here's an example for a menu, for example. You can get these menus anywhere. There's a lot of companies that offer these menus. There's a preferred, value, basic, economy pack. You know, how many payments do you have up on this? There's 12 payments in the bottom, base payment, there's 13 payments on a sheet. I don't think a finance manager can say, hey, here's your preferred package, includes the service contract, includes your maintenance program, includes your gap protection. Includes roadside, includes VIN-X, includes your credit insurance, and only makes your payment go up $120 a month. That's not the way to sell it. So, menus came about again to offer many different products. And again, I'm an advocate of a menu used properly. It came about to manage compliance as well. Manage compliance, you can't load up a payment. Sure, 100% of the products are offered 100% of the time with 100% of the customers. The point I want to make here is make sure your finance manager builds value on those products and just doesn't throw it down on a piece of paper on a monthly payment and put all these choices out there and hope the customer picks one. Do they have to sell? It's step selling. Your representative, F&I consultant, needs to have the knowledge to be able to train those finance managers to do that. All right? Other services, claims administration. When you're looking at that service provider, who's providing those F&I products, see how they're doing their claims. Let's take, for example, like on your warranty claims. A couple things you got to look at. How much control do you have on denied claims, for example? There are going to be denied claims when a customer comes in that service shop. Service manager is going to get yelled at, salesman is going to get yelled at, sales manager is going to get yelled at. Maybe it's a gray area, all right? How much control do you have that over a dealer to review that claim? What's the escalation process of reviewing that claim? And I'll tell you right now, most dealers own their own captive reinsurance companies, which I'm going to get into in a minute. And when you own your own company, you have a lot of control over this. That's what we're going to get into a little bit. Are your customer repairs sent back to your dealership? If it's an engine repair, you want that engine being fixed in your shop, not the shop down the street. So if it's within 50 miles of your dealership, they should be directing that customer back to your dealership. How are transient claims handled? That's if they're out of town, they break down going to Disney World with the family. Car breaks down in Florida. Do they have to pay the repair and they get reimbursed? Or do they pay for it right on their credit card and keep the customer happy, as with customer satisfaction? Hold time on the phone. Your service advisors back there do not need to be sitting on the phone for 15 minutes waiting for a claims adjuster to pick up the phone. So make sure that company is picking up the phone and answering the phone and not leaving their people on hold. Now when I started, I said there's two sides of the coin. One side of the coin, I said, was services. The services they're providing your dealership and the training. The other service is back-end participation. That's the profit of it, all right? What I'm trying to do is share with you, what are you paying for these services and what are you getting for the services, all right? The back end, that representative walking into your dealership, his fees are going to be shown in here. I'm going to show you how the fees break down. Now, what do I mean by back-end participation, underwriting profit? You have an F&I cost sheet for your warranty cost sheet. $900, the cost sheet says $900, the finance manager sells it for $1,800. Take the $900, he books it on his F&I log, the $900. It's front-end gross profit in the F&I log. I'm talking about that $900 cost sheet. He looks at that cost for $900. How much of that $900 cost do you get? All right, that's what I'm calling back-end participation. All right, there's a lot of different structures for this. And most dealers, but not all dealers, participate in this. If you're not, you should be. There's controlled foreign corporations. There's non-controlled foreign corporations. I'm going to put those two together. I'm going to call that captive reinsurance companies. All right. Retro agreements. A retro agreement basically says, Mr. Dealer, we're going to give you a portion of that underwriting profit in a check every year. Might be 80%, 90%, 100%. The retro agreement, what you've got to know, if you get 90% of the profit, 90% of what? All right, you got to know 90% of what. And I'm going to show you what that of what should be. All right. Direct dealer pack programs. This is not back-end participation. All that is you have a $900 cost on that warranty sheet. They put $100 on it and say, Mr. Dealer, I'm going to send you $100 every month back to your store. All right. That's not participating in the $900. They're just adding $100 to the cost and sending the dealer $100. The dealer pack. I don't call that back-end participation whatsoever. I'm going to concentrate on captive reinsurance companies. It is the most profitable place for a dealer to participate or get these back-end profits. All right? So controlled foreign corporations and non-controlled foreign corporations. Let me give you some history. What it is you're going to own a reinsurance company. All right? Since you own the reinsurance, you're going to get all the benefits just like you own your own warranty company, but without the risk, without the liability. All right? So, opportunity, you buy stock shares into a reinsurance company. Your F&I provider should be forming a captive reinsurance company for you. You're going to buy stocks, you're going to own it. Since you own it, you're going to get all the profits, all the underwriting profit, all the investment income. It's not a new idea. Okay, it's been around for a long time. It actually came out in the 1960s. Auto dealers actually were one of the first ones that started it. Auto dealers had captive reinsurance companies for credit insurance back in the days when we used to sell credit insurance. It evolved into auto warranties. I actually took it to the home warranty market with real estate brokers and mortgage companies back in 2005. And today, thousands of auto dealers have this type of structure. We personally handle about 4,300 auto dealers in this type of structure. So most dealers do have this, but again, not all. And I tell you, a lot of independent dealers don't have this program, nor have they been offered this program. And it's a very viable option for independent dealers as long as they're doing some decent volume. What I mean by decent volume, if you're going to have your own captive reinsurance company, you should be doing at least a dozen warranties a month. It's not designed for a dealer that's going to do 3 or 4 warranties. All right? But a lot of times they're not even offering these to independent dealers. Some of my most profitable clients are independent dealers, doing 60, 70, 80 warranties, making a lot of money. And I'll show you the kind of money what we're talking about. So the company that's going to be managing it, if you're going to have your own reinsurance company, what's the first thing you want to do? Let's remove your risk, let's remove your liability. What I mean by that, your claims exceed your bank account, you have no risk. There's going to be an underwriter, a fronting company. This company insures your reinsurance company. Put $1 million in the bank, your claims go to $1.2 million, your liability stops at the money they put in the bank. What you want to do is have an A-rated insurance company. Now, usually there's an admin obligor on it. Admin obligor, who's obligated to perform the duties of that policy, is what they call the obligor. That's agreement between the customer and the administrator obligor. All right. So if the customer is going to sue a warranty company, they're going to be suing the administrator obligor. Your captive reinsurance company is not the administrator obligor. Okay. You're just going to be receiving all the profits on it. All right. There are dealer obligor policies out there. Dealer obligor policies, it's an agreement between the dealer and the customer. You don't see them as often. It's usually the lowest admin fee you're going to pay because you're just paying someone to administrate your claims. The downside to it, again, the highest tax consequences of it. You're not getting the advantages of what insurance companies do in tax, which I'm going to go through in a minute also. So when you're looking for that company, make sure your underwriter is an A- rated or above. You're going to need A- or above, or your lenders aren't going to finance that contract. All right. What are the products you should look at to put into a captive company, your own company, to reinsure? Well, extended service contracts are by far the #1 product you run through captive companies. Gap coverage has come a long way in the last few years. When Gap first came out, the claims actually exceeded it. They went negative. Premium was too low. Lenders were advancing 140, 150%, plus back-end advances were very high. No limits on the gap coverages, and it's priced too low. Today, there's limits from lenders. The lenders limit the advances. Gap companies usually limit to 120, 150% of NADA retail, so the risk isn't great. So now it is actually a product you can look at reinsurance. Appearance protection, fabric guard, paint sealant, rust proofing, very low claims, good premium, great product. The smaller premium policies, tire and wheel, remote key, VIN-etches, those products are designed for low cost, easy, VIN-etch, for example, $20 cost, they sell for $179. It's not a reinsured product. The product I want to concentrate on is extended service contracts. Credit insurance, nobody's really selling that anymore these days. Let's talk about warranties and how that relates. I'm going to show you how warranty runs through a captive reinsurance company. All right, in your service contracts, most of your service contracts have a wrap policy that basically wraps around your powertrain, your factory powertrain warning. It's 100,000 powertrain by the factory, it wraps it. Comprehensive is an all risk. We cover everything but what's named. And you have named components, high tech, standard, powertrain, for example. These are named component coverages. What you see named is covered. Now, my dealers, I usually recommend to have two. Have what I call their own warranty program, standard program, and then have a high mileage program, which is a direct program. What I mean by direct is the premiums on a high mileage program do not go to your bank account. Do not go to your captive company. These are typically your higher risk cars. 90,000, 100,000, 120,000 mile cars. Take those out, don't take the risk of those cars. A reinsured program, for example, a 2-year warranty usually will stop like at 75,000 miles. A 3-year warranty will stop at 36,000 miles. Well, your high tech is much more, your high mileage program will have a much more expansion eligibility for your cars. You can have a 100,000 mile car, get a 2-year or 3-year warranty versus a 12-month. Well, it's easier for your finance manager to sell $1,800 for a 2 or 3-year warranty than $1,800 for a 1-year warranty. Then you take that higher risk car and do not put it into your company. So I usually recommend to have 2 companies there. Here's where it gets some of the fun parts. I'm going to go through the fees. You know, Paul's telling me, I always say you should know what you're paying for and what are you getting for those fees, all right? Those fees for your representative walking in that dealership, those fees to manage your captive company, all those fees are going to be put into fees what they charge your captive reinsurance company, all right? Now, dealers over all the years have been very well trained. When those companies come in, I want to manage your captive, what's your admin fee? What's your admin fee? What's your admin fee? And they only ask that. All right? They forget to ask about seating fees, annual maintenance fees, setup fees, the seat written is earned. I'm going to show you each one of these fees, where they're placed and what it means to you. All right? So, when you're looking at a captive management, so the setting up a captive company, you should be knowing what to look for. Again, know what you're paying and what you're getting for that. The company manager reinsurance company should be running the financial statements, your financial reporting. You should be doing your tax returns. Company valuations, your profit projections. You should be saying, here's how much profit you got in it now. Here's what you need to still in reserves. Here's what you can take out in dividends. And your representative should be sitting down with you at least on a quarterly basis and showing you this as well. Get them all available online. What you want to do is very out in the open as much. You should know exactly what this $900 costs on that warranty. Where exactly does that $900 goes? Who's getting what and where's it going? Right down to the penny. And you should be able to see every dollar where that's going. So I'm going to give you an example of how the money flows on this. This is going to be a warranty, for example. You got reserves 520, that's going to be an underwriter. Admin fee of 175 is about an average admin fee. The rep coming into your dealership, that's going to be included in that admin fee. All right? When I was a representative, I used to tell my dealers what I made per warranty. I don't think there's any problem with the dealer asking the representative, what are you making per warranty? All right? You know, $40, $50, and they should work for that. I'll be honest, there's representatives out there put $100 or $200 into this fee, and they do no service for the dealer. They come in once a month, and they collect the policies and collect a check. And dealers go 100 warranties a month, and you put $200 service fee, and that F&I person's making $20,000 a month from that dealer, and the dealer doesn't even know it. All right. You know, hopefully they do something more than pick up the mail, but many reps, that's all they do is pick up the mail. So you want a qualified rep as a next to begin with. So let's show you how this money runs here. You know, here's the $700 they put in the F&I log. I'm going to use the $700 cost for an example for a warranty cost. All right. I'm going to show you a pro forma. This pro forma is if you were had your captive reinsurance company for 5 years and stopped it, what kind of money would you be looking at, or where the fees are? All right. So here's an example. If you sell 100 warranties a month, I took an average of new and used car, that's $712.50. You never see a cost like that on an F&I, on a warranty cost sheet, but that's just an average. So 100 warranties a month times 12 months, $855,000 you send out to the warranty company. That's the cost of those warranties. All right. Now the question is, as you as a dealer, how much of that $855,000 are you going to be able to keep? Take out your admin fee, $175,000. It's $175 or $210,000. $645,000 goes to your bank account. All right. Let me clarify. I'm going to say your bank account. Your bank account is your captive reinsurance company's bank account. It's a trust account. Captive reinsurance company's bank account, who owns the captive company? The dealer does. So that's why I say it is your bank account. All right? So, $645,000. Now the key is, you want as much of that $855,000 going to your bank. Keep that in mind. You want as much money into your bank account. Right, so, that is called sheeted as written. That means every dollar goes to your bank account. That means as written, we're going to put it all right in your bank account. Let's take out claims out of this. What are claims going to be? I ran this example, just 50 new car policies, 50 used car policies, new car being a 72-month warranty, used car being 24 on average. I ran the claims out at a 65% loss ratio, that's national average. I've got clients who run as low as 35, I've got clients up as 90. This is an average. So I'm going to take out all your claims there, all right? After you take out claims, here comes a couple more fees. Now, all your companies are control. This is a controlled foreign corporation. You're going to have a 1.5% state tax, 1% excise tax. I've already taken that out. You're going to have an annual maintenance fee. This is usually your resident agent in one of the islands. It's going to handle just your annual maintenance of that company. $2,800 is a good average number. You'll find companies will charge $10,000, $15,000 a year. That adds up if you go on this thing for 10 years. So recognize what that annual administration fee is. That money's going to sit in your bank account. It's going to earn investment income. Investment income is going to be at the direction of the underwriter. You can't go play the ponies with it or take it to Vegas. All right? It's going to be Grade A bonds, money markets, CDs, what have you. The only thing taxed on here now on control foreign corp is your investment income. You see the number, 567, 457, you get second year, 412,000. That money being pumped into your bank account. That 3.2 million is exceeded, is earning investment income. That income that they make every year, there's no tax on that. One of the advantages of having an insurance company. All right, you don't pay tax on investment income. So you see the bottom line the first year is $569,000. All right, now that's not $569 that you can go spend. It's $569. This is cash flow. $569 sitting in the bank account. Some of that's earned out as profit as dividends, some of it's still in reserves. But I'm showing you a 5-year picture and stop in what you're looking at here. So, you run for 5 years and stop, that 6 is runoff. Now only runoff, if you've got a new car policy for 6 years, you sell a new car policy in the 5th year, you got 6 years for that policy to expire. But if you just stopped and ran this off, that's $1.5 million, lower right-hand corner here, all right? If you're a dealer taking a dealer pack for $100, you're not getting the $1.5 million. All right? If you are on a retro agreement and they're giving you 90%, now you got to find out 90% of what, depending on where the fees are and what they're putting in that bank account. All right? Now I mentioned 2 fees there. Your admin fee, what everybody's going to have. Annual maintenance fee, what everybody's going to have. There's a setup fee to form this corporation. What's a reasonable number for a corporate to set up the corporation? Pretty inexpensive. Look at $3,500, $4,000 to do it. There will be companies out there that will charge you a lot more than that. All right. Now this is typically when I do programs. This is the only fees: admin fees, now setup fee, and an annual maintenance fee. There's a couple other fees you have to watch for. I don't charge these. Never have. Seated as earned or seated as written, and a seating fee. Let me tell you what I mean by that. All right. Seated as earned. Let's just do a straight line pro rata, for example. It's a 4-year warranty, and reserves are going to hold 25%, 25%, 25% for 4 years. So they'll only see 25% in your bank account. That means as the reserves earn, then they're going to put it in your bank account. All right? I'm going to tell you the difference here. Look at column 1, the first year. Seated as earned, $125,000 went to your bank account. Seated as written, $645,000 went to your bank account. Where's the difference here? Who's getting the investment income? Here's your investment income. If you look down in column 6 here, investment income, $535,000. If it's seated as written, $253,000 seated as earned. Where did $300,000 go? That's a fee. All right? 10% seating fee. What does that mean? Well, we're going to take 10% of that money when you put it in your bank account. Just a fee, we're just going to take 10% of it. So if it's 10% seating fee is written, they're taking $64,500 extra every year. Here, seated as earned, where they only seated $2.9 million went to your bank account. Here, $3.2 million went to your bank account. So quick, a simple, same program, same admin fee, same volume, same everything. If we have a seated as earned and 10% seating fee, that $1.5 million just went to $1 million. To $500,000. All right, to $500,000 in fees. All right. So what I always say, it's good to know what you're paying and what are you getting for your money? All right? If there's an extra $500,000 fees and you add your agent fees on top, it's part of the fees for servicing reps. Know what kind of services you're providing your dealership. You should require more than someone coming in, picking up some policies and a check. All right? Look at the structure of your reinsurance and what the fees are. The most common reinsurance company there is a controlled foreign corporation. I'm not going to break down the difference between a non-controlled and controlled. I don't want to get that much detail today. The most common is controlled foreign corporation. Definition of controlled foreign corporation, $1.2 million of ceded premium. Means don't put more than $1.2 million in your bank account a year. If you put more than $1.2 million, you become a large-sized casualty company. Difference there is all that money I showed you, ordinary income tax. Medium-sized casualty company, tax only on investment income. Your provider should put the right appropriate program together with you. If you're larger than 1.2 million, then you're looking like a non-controlled foreign corp or multiple controlled foreign corps. I'm not going to get into detail. Your provider should know and the expertise what's the best program for you. Nice thing about that is that underwriting income just stays there and grows in a tax-free environment. You say, hey, great, Doug, I got $1.5 million in there. How do I get it? You request a dividend. Dividend tax rates are 20% now. 15% just a few months ago before January. They're 15%. Now they're 20%. Send me a check, you get a 1099 of a dividend tax rate of 20%. Still a lot lower than ordinary income. Hey, Doug, is there anything else I can do with that? Well, my dealers do a lot of things with it. For example, it's probably the #1 avenue how dealers buy additional dealerships. All my dealers have bought dealerships with this. They get $2, $3, $4, $5 million built into this. They want to buy a dealership. Hey, I'm going to borrow $2 million from my reinsurance company. I want to buy the dealership. The dealership's going to pay that $2 million back to my reinsurance company, and I'm going to pay myself the interest. They become the bank. Some dealers will say, I'm getting tired of floor plan expense. 6, 7, 8% on floor plan. I want to carry the floor plan myself. You want to knock off $1 million off your floor plan? Charge the dealership the floor plan expense. Just don't give it to the bank anymore. You just became the bank. Give that to your reinsurance company. All viable investments of a reinsurance company. All right. Where they're formed, I've been doing it for Turks and Caicos for about 20 years, 30 years. You'll see Turks and Caicos, Belize, Bermuda, Puerto Rico, a lot of different countries and islands. Most of them do offshore now. They're controlled foreign corps. Keep in mind, it's U.S. control. We file U.S. tax returns. The money's in a U.S. bank account. Why they moved offshore? When I first got in the business, they were all done in Arizona. Almost all your major corporations have reinsurance companies offshore. If they have insurable risk, you'll see these corporations. There's thousands of them down here. Mainly due for capitalization, easier capitalization to start these companies. But keep in mind, it is a U.S. controlled corp, U.S. tax returns, and the money is in a U.S. bank account. All right. When I first started my home warranty business, and I brought this same program to real estate brokers and mortgage companies. They had very little knowledge of captive reinsurance companies, and they're very nervous about foreign courts. Nothing to be nervous about that. So what are you looking at? What are you doing? You're an investor. You're buying shares in a producer-owned reinsurance company. Port. All right. I don't like my agents using the word port. They used to go up to clients of mine and say, hey, I want to set up a port for you. Well, port job. It's a producer-owned reinsurance company. You own it, you're the investor. You're going to have a direct writer, the administrator obligor, whose obligation to perform the duties of that carries the liability. You're going to have an underwriter or a fronting company. That's the company insuring the whole program. All right? If your claim, you say, great, now you put all that money in my bank account, and my claims went haywire and exceeded the money in my bank account, what risk do you have? None. There's no risk. The claims exceed that, the underwriter's insuring it. They cover it. Hey, Doug, I know, customer's going to sue the warranty company. Who are they suing? Not you. They can sue you. They can sue anybody they want. The obligations of that policy is the admin obligor. So what's the beauty of it? You're getting all the profit without the risk and without the liability. So when you're looking at that representative walking in, all these reps walking in your dealership, you probably get 20 or 30 of them a year, carry my products, carry my products, carry my products. How do you choose which is the right one? Start first off with who's coming in your dealership to do the training. You do not get underwriting profit from products if the product is not sold. That representative should be giving you the proper training to make sure those products are being sold. To your finance manager, to your salespeople, to your sales managers. They should be well versed in everything in that dealership. They should be a pro. They should be the best of the best. Make sure they have a solid presentation, proper setup. Make sure the salespeople bring into the deal appropriate to the F&I department. Make sure the sales manager working deals appropriately. Look at product administrator, who's underwriting it. Make sure it's an A- at best underwriter. And I strongly advise you have an underwriter on your service contracts. Look at the fees associated with the structure, all right? Don't ask just what's your admin fee. There's so many other fees that you need to look at there. Again, I don't think there's anything wrong asking your representative, what are you making per warranty? All right? I know what some agents out there put per warranties, and if you'd be shocked if you've seen some of these fees. You might be shocked if you knew the representative coming in to pick up your mail once a month is making $10,000 a month to put a stamp on an envelope. All right? I'm showing you where these fees come from. All right? Make sure you're getting the most out of both sides of the coin. Coin one being the service what they're providing your dealership. Coin two, make sure you get all the profit you can on the cost of those products. Two sides of the coin. Okay? That's it in a nutshell.